Hello, hello, and welcome to this month's episode of Elevánt Insights. We are super excited for today's topic, as last week was a really fun week in the markets. I'm sure everybody was excited to watch all of the red from last week. And so we have been a little bit spoiled with a little bit of green in the markets for the last couple, almost couple years now. And so we're excited to take a deep dive, not into just what happened in this last week, but also to look at things more broadly and holistically as to what's going on in the market. So we have some awesome guests to introduce, and we don't want to take too much time to waste away from them, but we are very excited to get them talking and to have us stop talking. So before we jump into that, though, if anybody has any questions while we get into this webinar, the way we would do that is you would raise your hand in the actual Zoom webinar. And so down on the bottom, there is a thing that's called reactions. So if you see that at the bottom of your screen, you click on reactions and you click raise your hand. If you raise your hand, we will actually unmute you and you'll be able to ask a question. So if anybody has any questions throughout our presentation, we can do that. We'll try to save them for the end. But as always, we're very excited and grateful to have you joining us today. And we're going to jump right into Dan, who can introduce our guests.
Brian, do you want me to introduce JoAnne first, or did you want to introduce Mike for just a moment?
Yeah, sure. I'll introduce Mike. So, and then Dan, I'll let you introduce JoAnne. So Mike, we'll give you a couple minutes. So Mike is with Advisor Capital Management. So we typically work with Advisor Capital Management in situations where we're dealing with higher net worth investors who are looking for more custom strategies. You know, oftentimes we'll be using individual stocks and individual bonds with these types of strategies. And so Advisor Capital Management is a great resource and a great partner in working in this type of a space. And so Mike, if you want to take just a quick second and tell us about who you are in reference to Advisor Capital Management, and then maybe a little bit about Advisor Capital Management, that'd be great.
Yeah, thanks so much, Brian. Yeah, and no different today in the markets. We're definitely experiencing some volatility, and you look at a lot of the geopolitics, that have occurred in the last week or two. It certainly makes sense, and so. Yeah, Advisors Capital Management is what we would consider a boutique investment management firm, and everything we do offers customization for clients and accessibility. You'll spend a little time with Dr. JoAnne Feeney today, who is one of our lead portfolio managers on several of our strategies here at Advisors Capital Management. We're still a family-run firm, and so we have about 100 employees and manage about $8 billion in assets under management. Again, we really pride ourselves on service and accessibility to portfolio management team and really all of our employees. And so advisors that work with us really get to know us well. And so we're really thrilled as a first-time guest here with you all. And with that, Dan, why don't you take a moment to introduce JoAnne, and we'll go from there.
Great. Thanks, Mike. As was mentioned, today our guest is Dr. JoAnne Feeney. She's a portfolio manager and member of the investment committee at Advisor Capital or ACM. Prior to joining ACM, Dr. Feeney was a senior equity analyst at several boutique firms for over the last 10 years. Well, 14 years before joining ACM, I should say, including firms of Punk, Ziegel and Company, FTN Equity Capital, Longbow Research, and ABR Investment Strategies, focusing a lot of time on valuations of semiconductors. Dr. Feeney also consulted for the Federal Reserve, International Monetary Fund, the World Bank, while an academic at the University of Albany, State University of New York, the Stern School of Business, New York University, and the University of Colorado at Boulder. Quite an extensive academic exposure there. Dr. Feeney also has appeared often on Bloomberg, CNBC, and is frequently quoted in Barron's and Wall Street Journal. Her BA is in economics from Union College, and her PhD and MBA in economics from the University of Rochester. Dr. Feeney, the floor is yours. Go ahead. Thank you.
Can y'all hear me? Okay, sounds good. Nice to be with you all. I understand you're on your lunch break. I'm on the East Coast here. It's 2 o'clock or so. And I would love to try to give you some perspective on what's been going on in the markets and in the economy, and certainly touch upon at least how, as investors, we deal with the global political risks that we're now facing. So I have a bunch of slides here, which has some graphs that are just illustrative, but we'll just talk through what's been happening, over the last year or so, because it's important not to be too short-term focused as an investor, as a client, to make sure you understand really what the bigger picture is for your investing strategy over the long haul. So, what we try to do as managers for you at Advisors Capital Management is to take into account both the global macro economy and how different economies might be going through different cycles, and also then look at how the world is changing. How is technology evolving? What is AI going to do to investing? That's been the big buzzword lately. And before that, it was, moving to the cloud. Before that, it was the oncoming internet, right? So there's always big changes afoot. And those changes can point to investing strategies. So we take all that into account when we build our portfolios for you folks. And so what I wanted to do is just give you some perspective. And so this is a little bit, I had to submit these slides a little early. So these are mid-March numbers, but I will give you some comments on what has happened since then. But to mid-March, the S&P was up about 7.5%. It was then up a little bit. And then last week it pulled back a little bit, right? But essentially we're still in that same neighborhood. A big part of that rise, nearly half, was due to what's called the Magnificent Seven stocks. And those stocks have become, the top. They were the top 7 stocks in the S&P 500, which is the most common index that people watch, like Google, like Amazon, like Nvidia, Microsoft, etc. People are now starting to refer to them as the Magnificent Four, which doesn't really suit the movie reference, but that's because things like Tesla and Apple and some of the others just haven't been doing nearly as well. But it's still the case to be aware that the index that you typically watch is dominated by the biggest companies in the index. And the reason for that is how the index is simply constructed. The index is constructed by weighting the top 500 companies in public markets, but they're weighted not equally. They're weighted by the market capitalization of the companies. And so when you look at the markets, you're typically seeing what's happening with the biggest companies, just to be aware. And chances are your portfolios, at least if they're built by us, are not going to own as much of those big companies as are in the index. You're going to be better diversified than that. You might have more income than those kinds of companies would deliver in terms of dividends. So you have to really distinguish between your portfolio and what's going on in the market. And the average stock, for example, is up only 4 and a little bit % relative to the S&P 500 index, up around 7.5%. So important context to understand about what your portfolio might be doing in this kind of context. And if you're well diversified, you're not seeing as big swings in your portfolio as what we might be seeing in the S&P 500. And here's an example of that. So the blue line is the S&P 500 over decades. Over 1 year. That's the blue line. But this is the Magnificent Seven. That group is up a lot more. So the market as a whole, is more diversified. It's broad. It's got industrials. It's got materials companies. It's got financials. That's not what people have been focused on. It's been driving the index. Also, it's the case that those 7 companies, even year to date, have been still driving the market. And so again, a very narrow view. It's not something that typically lasts over the longer term. And when we look also, this is an important context for a lot of folks that are in, say, something like our balance strategy, where income is an important part of what you're trying to achieve and what Dan and Brian are trying to achieve for you, which is to generate some dividend income off the equities in your strategy that you're using to, say, live on, pay some of your household expenses. And so when we look here, we do notice that dividend paying companies, which are the ones that are in blue or purple, dividend paying companies have appreciated less, have seen their shares appreciate less year to date than the market as a whole. The reason for that is because this S&P 500, which is the white line, is being largely driven by these big companies that don't pay a dividend or pay a very, very tiny dividend. Again, Tesla or Apple or Microsoft or Nvidia, etc., pay very little in terms of dividends or nothing at all. But you're getting something in return. Even though these stocks aren't appreciating as much, They are paying you that dividend. They've committed to the dividend. It's very unlikely that they're going to cut the dividend. And chances are, over the longer term, your stock portfolio is less volatile than the market as a whole. So that's some context. And here's a more specific numbers. Again, from mid-March, you can see the divergence between what the market did, which is again up 7.5%, and what these magnificent 7 companies did. Really massive divergence, say, between an NVIDIA and an Apple, and then the S&P 500. Okay, what we also see is that those high dividend payers did less, as I showed you in the graph. And so it gives you some context. You want less volatility, you go to dividend payers. You want to see more appreciation, you're going to have to take more risk. And that's what we're seeing over and over again in the market's reaction. Last week, the market was down. Why? Those inflation numbers came in a bit hotter than expected, creating worries that the Federal Reserve wouldn't cut interest rates as quickly as some would like. And of course, because of the threat that Iran was going to attack Israel over the weekend, we had a lot of folks pull back from equities on Friday to try to take less risk in front of that kind of geopolitical concern. We also tend to see divergence in sectors. So if you're invested in infotech, where a lot of that growth has been happening, that sector's been up a lot year to date. Whereas safe-oriented sectors like utilities, or real estate, or some of the staples and other consumer stocks, didn't do as well. So there's been what's called a risk on trade. There's been a real flip-flopping of investor attitudes this year, particularly towards let me go for high return, high risk versus let me go to safety. And right now we're in a situation where the geopolitical risks and the macroeconomic dynamics have been driving this switch in attitude towards risk and away from risk. And let me show you sort of where that's coming from. So first of all, this is a graph that shows you how expensive stocks are relative to the earnings their companies are capable of producing. So this is the price of stocks relative to the earnings for the next 12 months. And this is for the whole S&P 500. And what we're seeing right now is that forward price to earnings ratio is at around, just over 20 times. And that's above the long-term average. On average, that's around 16 times. So that makes some people nervous. It says, the market doesn't seem particularly cheap right now. Can equities continue to rise? And the answer is yes, equities can continue to rise, but this chart tells you you should be careful about which equities you own, because there are some stocks in the market that are driving up the average for the whole group of 500 companies. And that's where we as managers are trying to go and find some of the cheaper stocks that are very good companies that have staying power for the long term. And what we look for is the capability of companies to deliver earnings. So those top 10 companies in the S&P, those are the most expensive, among the most expensive. And if you just look at the top 10, they're trading more expensive than the market is on average. So that gets back to that Magnificent Seven group. They're high growth, they're higher risk, they're more expensive. So we want to stay away from, a portfolio being dominated by those. We want to be more diversified than that. We also want to recognize that right now, value is relatively attractive on a historical basis compared to growth. And so we want to be able to pull in some value names. This is a particularly good time to do that because of how expensive the market is. But the big thing that we look for to design portfolios is how much earnings companies can deliver. Because ultimately, it's the increase in earnings that creates stock valuation increases. So if you're a company, you produce stuff, you sell it, you generate profits. How valuable is the company? The more stuff they sell, the more profits they generate, the more valuable they are. And what we're seeing recently is that most of the profits that are being created by companies in the form of earnings per share, most of the increase comes from revenue growth, that is how much stuff they sell, and margin, how much profits are making per dollar of sales. And what we saw last year was margin went down. So profitability per dollar of sales fell, Whereas in the previous couple of decades, margins were expanding. So things got more competitive last year. And if you think back, you'll understand why. Inflation was slowing down, but costs were still rising for firms. And so their margins were getting squeezed. That's why the market suffered last year in certain pockets, was because profit margins were challenged. And that's why the market went down in 2022, because everybody looked forward and they recognized, okay, 2023 is going to be a tough year. Profits aren't going to be as strong. Inflation is fading. The ability of firms to raise prices is fading, and profit margins are going to shrink. And that's exactly what we saw last year. And stocks tend to trade ahead of that. And so we saw a pretty significant decline in profit margins. But from now going forward is what you care about for your stocks today. You care about the future, not about the past. And what we see for the future is a pretty solid economic backdrop for investing. We see real GDP growth in the 2-ish% range for the next few years. That's not a recession, no recession on the horizon. All right, that's solid growth, a little bit above trend. Today we had the retail sales number looking really good, came in ahead of expectations. Consumers are still out there spending. And so these numbers are probably going to go up from here because of that recent data we've had. Inflation over here under price indices, CPI inflation expected to come down, right? The Fed's doing its job. Supply constraints are easing. Unemployment likely to remain low. Maybe it hits 4%. So the economic backdrop is important for firms because it determines how much they're going to be able to sell, how healthy their customers are. And it looks like right now, customers are going to keep their jobs. They're going to be able to continue spending. Again, a solid backdrop for companies to sell stuff and generate profits. Now, there are always a lot of questions out there. What's the Fed going to do? Is inflation going to fall? Is the Middle East, war going to get worse? There's always issues, and that's why we have to create a diversified portfolio. Inflation is mostly falling. Expected to continue to fall, expected to hit the Fed's target in a 3 years. Interest rates are high now, and they will fall more short-term rates than long-term, because long-term interest rates around 10 years around 4.6-ish% today, probably comes down some because they're elevated right now on some of the geopolitical risks, some of the concerns on continued, higher than expected inflation, but coming down. So we should expect to see interest rates fall. That's a positive for stocks. We should expect to see short-term rates, which is what this chart is, come down over the next couple of years. We're at a high right now, but coming down. And we should expect that while unemployment is really, really low, it probably ticks up a little bit. But we're in really a pretty healthy environment. In fact, the tightness in the job market, which was measured by how many job openings were posted, those job openings that are posted and surveys are measuring, those job openings are falling. And they're falling pretty steadily. So that's a good sign in the health of the labor market. Firms are able to hire so they can take those job openings down off the list. People are getting those jobs. Consumers and households have more money in the bank, more money coming in with their paychecks. And that's what's been supporting consumer spending all this time. And here's more evidence. Unfilled job positions are starting to get smaller. It's a good sign because there's less upward pressure on wages, which is good for the inflation story. Okay, so right now we don't anticipate a recession anytime soon. Right now the data suggests there's nothing that would cause a recession, which would be a broad-based pullback in production and a broad-based pullback in people having jobs. We don't see anything in the data that suggests a recession is on the horizon. Things are pretty healthy. More and more people, by the way, are getting jobs. More and more people are returning to the workforce because there are so many positions available. Households are in pretty good shape. Yes, consumer credit is up. You might see headlines, oh, credit card balances have reached a record, or delinquencies have reached a record. It's really important not just to look at the absolute level of credit card balances, but to look at it relative to disposable income. Because we're a growing country. Right? There's going to be more credit card balances. There's more people, right? And people's wealth is going up and more kids are becoming adults and they're borrowing. But if you look relative to disposable income, that neutralizes for bigger population, for more wealth. And what we're seeing is we're kind of back towards pre-pandemic levels. There's nothing alarming about consumer credit cards right now relative to our income. Household debt, again, the service, that is the amount they have to spend to pay their interest on their mortgages, to pay their interest on their car payments, pay their interest on credit cards. Relative to disposable income as a percentage, it's still using up around 10%. That's pretty normal. In fact, it's a little bit lower than where we were for most of this chart's history. So that's not too alarming either. Yes, we're seeing more delinquencies on cars, on credit cards, and those numbers are ticking higher. That's a little bit of a concern. And then you got to look deeper into the data to find out who is becoming delinquent, and then what is that doing. So that's one where, you want to watch that one carefully. Okay, so consumer spending has done very well, but the growth in consumer spending is clearly slowing, right? We're losing that as a growth driver, but it's still pretty high and pretty healthy. Personal income is still growing. This is a growth chart. It's growing a little bit. Now it's become a little bit flattish as of January. We'll get another reading here soon. But boy, it's been a pretty good few years since the pandemic of positive, real, that is inflation adjusted personal income after taxes. And spending has gone up with it. So pretty healthy for firms. We're seeing more and more people coming into the workforce and working, but that growth is slowing down. GDP growth is slowing relative to what it did in the post-war World War II period, but population growth is slowing. We're a pretty mature economy. This is all pretty natural. Okay, so what drives growth for companies? Well, partly it's how much they're spending on capital, whether it's new factories, whether it's upgrading the quality of the machinery in the factories, or upgrading the computers that people get to use, or other stuff. So we're seeing a pretty good investment across the board. And you can see that this is more important for technology and communication companies like Google than it is elsewhere in the economy. But we're seeing pretty solid data here. And we're seeing that translate into GDP growth of around 2% is likely. Now, the government is a headwind that we're worried about, in that the deficit spending is pretty high, and the accumulated deficits over the last decades or so has created a fair bit of debt relative to the GDP of the U.S. economy. In fact, we're up around, dollar of debt for a dollar of GDP. So that's a little bit high for the U.S. We're a big growing country. We can support that, but there are some concerns about the projection, about debt rising relative to GDP. And there's nothing magical, by the way, about more than a dollar of debt for GDP. So long as we're a growing economy, we can handle that. The concern is that with interest rates as high as they are now, that our interest payments on the debt are taking up more and more of the budget. And that's never a healthy thing. So there are some concerns about how much that debt is, and how we as a country are going to continue to afford it. So there's questions about whether we have to raise taxes in order to balance the budget, or whether we have to restrict spending. But as you can see on the left-hand chart here, there's not a lot of room to restrict spending, right? These entitlements you hear about doesn't give a lot of flexibility into the budget between Medicare, Medicaid, Social Security, defense. There's just not a lot of room. So that's why politics have become so fraught, is because it's just a very hard equation to solve to deal with the deficit and the debt. So that's a concern for interest rates. That's why interest rates might remain higher in the next decade than they have been in the previous couple of decades, because of that demand for borrowing by the government. I'm an economist by training. Supply and demand for loanable funds determines the interest rate. Demand for loanable funds, demand for money by the government to borrow to pay its debt, that's going to keep upward pressure on interest rates. So that's why folks are thinking interest rates stay higher in the coming decade than they did in the prior couple of decades. So it's something to be aware of, because it is potentially a limitation to how much equities can appreciate. But what we really like to think about for company by company evaluation is what earnings can they create. So in 2023, in the S&P 500, these are all the different sectors of the S&P. This is earnings growth last year. S&P 500 is over here towards the right. It was barely positive. So 500 companies, the sum of all those earnings, was basically flat from 2022, didn't do much. Big companies, declines were in the healthcare sector, materials and energy, all saw significant declines in earnings. And if you look at the stocks in these sectors, they matched that decline. Whereas consumer discretionary earnings grew, so reflecting a very healthy consumer. Now, what we care about is this year and next year. This year, it is expected that the S&P 500 companies will see earnings grow 11%, led by information technology companies like Microsoft or Apple or AMD, Intel, not Intel, NVIDIA, communication services like Google or Disney, healthcare like an Agilent or a Bristol Myers or a Pfizer, and financials, the banks that reported last week like JP Morgan, which didn't do so well but had pretty decent numbers. Citigroup, M&T Bank reported this morning very good numbers, Schwab, etc. So these are all expected to see decent rebound. If you remember, last year healthcare earnings dropped over 25%. This year they're expected to rebound. Now, as an investor, right, we can't try to time things very carefully. It's really challenging, but we can recognize some of the more long-term drivers. Healthcare, take for example, aging populations, not just in the US, but around the world, more innovations in medical devices and drugs. That means more treatments. That means people paying more money for those treatments, whether it comes through Medicare or whether it comes through private insurance, right? This is a secular tailwind for not just pharmaceutical companies, but for medical device companies and for the tool makers that make research into new treatments possible. Strong secular drivers. Yes, you're going to have years where things go badly, stocks come down, but over the long haul, this is a sector where we think, for example, that the secular drivers, the long-term drivers, are going to be very supportive of continued appreciation and value of those companies providing key solutions. And then following year 2025, again, 13% growth is expected for the S&P. So if you own a well-diversified portfolio, those companies in your portfolio should see this growth occur. That should translate into valuation appreciation or dividend payments, or whatever way the companies are returning capital. So overall, what we think at ACM is that yes, interest rates will come down eventually, but it might not be till next year, because inflation, while it's coming down, is proving to be stickier. The economy is proving to be stronger, so the Fed has no need to rush into interest rate cuts. And so on the macro front, you can't look for a big tailwind from the macro side. That means the attention has to shift to earnings. And so we're really hyper focused on what can companies deliver, whether it's a General Mills or whether it's an NVIDIA, whether it's a Microsoft or whether it's a Disney. What can these companies do to sell more stuff and generate more profits? Because ultimately that's going to be the bigger driver, at least for the next 12 months, as to stock appreciation. And so when we look at the history of market moves, right, what we see is that in any year, you see stocks go down. So these red dots and the numbers under them, like the minus 30% in 2001, minus 34% in 2002, the minus 34% in 2020. These are the maximum drop in the market within that year. The gray bars are where the market ended up for the full year. And so what you see in a lot of cases, you see all these negative drops. You see that the market actually ended the year up. So in 2000, whatever, this 8, the market dropped at 1.28%, but it ended up 23%. Last year, the market dropped 10% at one point. It finished up 24%. And these are S&P 500 numbers. So in other words, be prepared for volatility. It's going to happen. But look at all the gray bars above zero. Most years the market rises. And that's why being invested in equities is generally a good long-term strategy. Now, at any one point in time, you could have a market go down 38%, or during COVID, 19%, right? But if you can hang in and wait for the rebound, you're going to do reasonably well. Sorry, that was 2022. That was down 19%, but we saw a bounce back last year of 24%. So the point is, this year, macro is probably going to play less of a role because the market has now discounted the Federal Reserve cutting rates anytime soon. The economy is in pretty solid shape, and earnings look like they're going to recover. So it's likely to be earnings growth that's going to drive the market. And then looking to 2025, if the earnings forecast remains as strong as it is, we're likely to see a decent tailwind for stock prices. On the fixed income side, we do expect interest rate expectations to move downwards over time because we're going to get closer and closer to a point when the Fed can cut interest rates. But that's now likely to happen, towards the end of the year or next year. We need more data, just like the Fed needs more data to figure out exactly when rate cuts can happen. So overall, it's a reasonably good environment for investing, but things are expensive in places, and so that's why we're doing individual stock investing, so we can pick and choose and find the value stocks that offer an opportunity for investors, even when things overall are a little bit on the expensive side.
JoAnne, a
So,
quick
yeah.
question for you. For the remainder of 24, where do you see the indexes going? Let's just pick the S&P. You had the projection of a little over 13% for 25. Did I miss what you've had for the rest of this year?
Yeah, so those projections, and let me show you the graphs again. These are earnings growth projections, not market.
Okay.
Yeah, so I wrote a commentary about this, Dan, actually a few weeks back. Maybe it was more than that, earlier in the year. There's a parlor game right out there. People try to predict what the S&P 500 index is going to finish at. And what you've seen among folks that play that game is they had forecasts back at the end of last year for, whatever number, and the market has exceeded those numbers already, and we're in April. And so now you've got the technical analysts that do this sort of thing scrambling and saying, oh, geez, should I raise my number? Should I lower it? So what we think is better is to avoid that question entirely. Maybe that's a dodge, okay? But I'm not going to answer that question because I have no idea what the market's going to do. What I want to do is look at the stocks that we are selecting and try to figure out how much growth those companies can deliver. And that's why I prefer this chart as opposed to looking at the S&P 500 chart and trying to figure out that. What I care about is if I own a company in consumer discretionary, is it going to grow by more or less than what the segment's going to do? Right? Because that might then have an opportunity to grow even more than the market in that segment. So I care more about earnings because that's fundamentally what's going to drive the stock price up. And so in our balanced strategy, for example, we own about 45 or so stocks, individual companies are collected into that equity side of that strategy. And then, depending on how big the portfolio is, 10, 20 or so bonds, right? Each of them researched at a company by company level. And so on the equity side, right, I'm looking at how much revenue growth is possible for the company. Can they amplify that revenue growth by margin expansion? Because if they can, earnings growth is going to be even better than revenue growth. And then are they going to use the cash that they're generating to buy back shares? Would that be an extra boost? Or how much can they potentially increase the dividend? That could be an even bigger boost. So I'm looking at a company by company level at this point. And so we made some changes recently to the balance strategy. I bought a stock, I sold a stock, right? We're constantly looking to see, can we do better? And so the change I made recently was I got out of a company in the logistics space that paid very little dividend or no dividend at all, depending on which balance strategy I made the change in. And then I added a company in the logistics space that had a very high dividend. And so that switch basically gave clients more dividend income, gave them a bit more surety in the return in an environment where macro, probably isn't going to be much of a tailwind. And so I'm looking at earnings potential and I'm looking at making changes for higher quality companies in this kind of environment.
This fits pretty well. We next month, we are doing our Elevánt Insights on behavioral finance. And so I love that you've talked a little bit about how the markets actually grow is mostly driven by earnings. And your I guess highlight on earnings is really interesting because I often tell people that In the short term, the market may move based on fear or greed or tweets or headlines or whatever it might be. But ultimately, a lot of that is that we're humans interacting with this market that's causing gyrations. You'd mentioned earlier that last Friday there was a lot of people selling away from equities because of their flee to safety. But ultimately, whether or not Apple stock will go up is whether or not they'll convince me to buy another iPhone the next time I'm going around to get another iPhone, right? And so their ability to sell things, generate a profit with a solid margin, essentially is what drives these stocks. And I think, sometimes when we think about the stock market as this big thing, it's hard to really wrap our arms around what it is. It's this big thing that goes up and down, and I lose money and I gain money, and it's hard to quantify. But if we remember that we're literally investing in entrepreneurs' ability to drive a profit in any market condition, and any tax condition, and any political environment, and any, I think when we think about it that way, it brings a little more faith to this idea that we've got a lot of scrappy entrepreneurs that figure out how to drive a profit even in tough times. And so, I often follow up our conversations about the markets with this, and I'll ask you this as well in closing. And I've kind of heard this sentiment throughout, but can we have permission to be optimistic? I feel like the markets, or more importantly, the media, is very quick to help us be negative and help us be pessimistic. But can we have permission from Dr. Feeney to be, or is it Feeney?
It's Feeney. Yeah, the old
Feeney,
typo.
okay, perfect.
Yeah.
From Dr. Feeney to be optimistic moving forward.
Yeah. If you have a long enough time horizon, you can be optimistic. So people get in trouble, right, when they need something to happen within the next 6 months or a year when it comes to investing. If you need some amount of money in the next 6 months or a year, you better be in bonds.
Mm.
But if you look at the long history of stocks, they go up. Not an individual stock necessarily. Those companies can go out of business. And so number one rule, be diversified, right? Own good stocks, of course. That's the number one rule. Own good companies and be diversified, because stuff can happen. Things can go wrong. And, as outsiders, we can't get inside a company, right? And know everything, right? There are laws about this. But yeah, generally you can be optimistic because stocks go up over time, because companies can produce more stuff. They sell that stuff. They generate profits on that stuff, and you're the owner of the company, so you benefit from that. Now, that's not to say that there aren't significant risks out there against which investors need to take precautions, right? And that's where diversification comes into play. And that's where you can't be overly optimistic. Overly optimistic means putting your head in the sand and just saying, I'm going to buy Tesla and hope it goes up. No. That's not investing, right? That's hoping. You need to do your research. You need to own good companies, and you need to be diversified because you can't know everything. So there's room for optimism, but that doesn't mean you aren't cautious. And so I often have to remember, I'm steeped in it. I did my work as an academic in growth, in risk assessment. So, but it's important for clients to understand that there are real risks out there. Tesla's a good example, okay? Because everybody's like, Tesla's fantastic. Let's just own Tesla. Well, then look what happens, right? It can go badly for any one company. And this can be anything. Things can go badly. I mean, we like NVIDIA in our growth strategy. We recently did add it to balanced. They are the market leader in chips, but we're not going to put all our eggs in one basket. As much as we know about the technology, and I used to be a semiconductor analyst, so I've done the research on the chips and the architecture and the software and how it all fits together. And NVIDIA has a really deep moat, right? But something bad could happen that I can't anticipate. So I don't want to own too much NVIDIA, right? And so you always want to put optimism in context. But if you step back, diversified stock markets, just look at the chart. It just goes up, but plenty of bumps along the way.
Yeah, perfect. Well, thank you so much for your expertise and for your time. this webinar will be recorded and on our website for people to look at into the future. And we appreciate your context and your ability to take things that are very difficult to talk about and make them very simple. So I think that might be one of your superpowers. So thank you for that.
Thanks.
I appreciate that.
I'm glad to help. Yeah. Thank you.
You bet. So just to wrap up, again, I kind of alluded to it, but next month's Elevánt Insights webinar is going to be on May 15th. That's a Wednesday at noon, and we're going to dive into behavioral finance. And so we have an expert specialist in the world of academia who's going to come and talk to us about how we can manage our emotions and our feelings and our thoughts in reference to this up and down ride that we go on with the stock markets. And so tune in for that. And until then, we appreciate your trust as always, and we will see you next time. Thanks, everybody.